I want to share a quick story about a 33-year-old man who decided to pay in $100,000 per year into a whole life insurance policy. $100,000 per year at age 33, which means he has to be doing very well for himself, which he does do well for himself, but he pays it into a whole life insurance policy. His name is Steve. It's not me. I know him quite well though, since 2018. He actually works for Grant Cardone, and we've got a podcast with him on our YouTube channel. But I remember the day he reached out interested in a whole life insurance policy. It was March, I think 2020, tail end of winter, and one of those days when it's raining and it's like borderline snow, ice, it's cold, windy outside. I describe it in that fashion because I had just gone for a run and it was just like cold and damp. I'm trying to warm up afterwards. My brother got in a car accident and just driving right down the road. He was fine. But I remember all that happened, and then I get an email from Steve interested in a whole life insurance policy. Now, when he emailed me, he didn't say, hey, I want to pay $100,000 per year into this policy. He emailed me for more information. He wanted to better understand it and see if it was a fit for him. He knew about it because I had sent him videos all the time, not to try and sell him on the product, but more so to critique the videos, because he's got a good mind for sales and marketing. So when he sees it, he would always give recommendations as far as, hey, you might want to tweak this or make a couple of adjustments here. I really like these. Those, didn't really keep my attention. So I'd bounce ideas off of him, but in watching the videos, you could tell he really dug into them because he inquired. He said, hey, can you tell me more about this? I'm interested in it. So to speed up the story, we looked at several different options, and he decides to pay in $100,000 per year into a whole life insurance policy. We're going to look at exactly what he does. And he shares details on his situation in our podcast as well. Now, when we connected, we did not just say, okay, $100K per year is the best option to go with. A couple things he mentioned. He said, hey, I don't want to have to pay until I'm 65 years old. The death benefit, not really feeling it right now. I don't care about it. In the future, I do, and now he cares about it more because he's married or he's going to be married soon, but the death benefit was not initially a concern. So we looked at different options based on his cash flow. At $50K a year, $100K per year, and $150K per year. He asked for one option. We showed him a number of options. He actually didn't start out at 100, but just as we went through the process, I said, hey, I can start by showing a couple different options. We can look at the guarantees, all that good stuff. He said, hey, that'd be great. Sent him all the info along with a personalized recording so we could see exactly how it worked. The same thing we would cover during a Zoom call to make it convenient for him as we went through the process. So he selected the 100K, but a couple things that kind of jumped out at him and things I remember is he was interested in the policy for this reason. He had money just sitting there in his bank account, earning 0%. His wealth building strategy presently is very effective. He invests in Cardone Capital. I don't think I spelled capital right, but that's okay. So this is where he's investing his money, and he's very happy with the internal rate of return. So it's a safe, consistent area to put money. No matter what happens each month, he gets a check, and when a property sells, he participates in that sale, gets his principal back, and another 2 to 3 times that. So he's very happy with investing with Grant. And when we looked at the policy, so what are the core benefits to a cash value life insurance policy? Specifically focusing on the cash value. That's what he was interested in. Safe, liquid, tax-free. Safe, liquid, tax-free. The IRR falls somewhere between 3 to 5%. IRR means internal rate of return, the net growth as time passes. Like, that's what the policy will do. He earned greater than that, even 5% with Cardone Capital. And he looked at it, he said, hey, I do earn a higher return with Cardone Capital with my real estate deals, but what I like about this is the idea that it's liquid, a cash alternative, and I really like this, Steve, the idea of getting $500,000 into the policy. So specifically what he wanted to do is this 100K per year for a period of 5 years, and then stop. He said, I really like getting 500K in there and just kind of letting it float, constantly growing. I really like the guarantees as I look at that. The tax-free benefit is nice too, because he's a higher income earner, so that tax benefit will become more and more valuable as time passes. But that's what he's attracted to. Getting 500K total into the policy, 100K per year for 5 years, and that's it. So when we set the plan up, we designed it where it could pay in for 5 years. But the product is actually a policy that's payable until he's about 95 years old. So if he decides to continue to make payments in year 6, guess what? He can do that. He is not forced to stop by any means. So let's take a look at exactly what he did here. So we looked at several different options, and we want to break it down too. So he's a quick decision maker, makes decisions quicker than most people I know. And I've noticed that to be very consistent with people at his level. He's got a goal to have a $25 million net worth in 10 years. I think he'll have more than that just at the pace he's going and how focused he is with everything. But he wanted the details. Just because he's in sales doesn't mean he says, hey, show me the numbers. If they look good, let's move forward with it. We looked at more than what I'm going to look at here. We looked at the guarantees, worst case scenario. You're going to see a couple variations of this option here, but 100K per year going in, he did not, I should have mentioned this earlier, he did not want to receive a bill for 100K. So we talk about this frequently. I want the ability to pay in $100,000. And with an insurance policy, I think what? Premium, bill, I have to pay it. However, with the policy, you can actually choose where your money goes. You can direct it toward an insurance premium, or you can direct it directly toward what is called a PUA rider. That's the compliant term. And that's what this column is here, this additional cash contribution. He's dumping money into cash value. It does impact your death benefit positively long-term as well. But money can go toward these two areas. And with his policy, his premium, which is his insurance premium, and also term insurance that we attached, is just about $10,000. To be precise, you can see it here, $10,200, and that's his premium plus his term insurance rider. Then everything else, $89,800 for a total of $100,000, all goes toward PUAs, hyper-growing his cash value. So how he's got it set up, he does not pay $100,000 at the beginning of each year. He commits to this. So on his anniversary date, when he gets his premium notice, like he would for any type of insurance product, that's when he pays the $10,200. And then at his discretion, he just logs onto his online portal and throws money in anytime he wants. I do the exact same thing with my policies. So he's got now not just a boring insurance bill, but he has a flexible savings asset where he can pump money in at discretion. It's really neat when you think about it. I've got a cash value life insurance policy, and I can use it as a safe, liquid, tax-free area to position cash. He looks at it and says, hey, I love the idea that it actually grows over time. My bank account doesn't do that, and I like the liquidity here too. So if my own real estate deal comes along that I want to personally control and invest in, I can now use my life insurance policy to take advantage of that instead of financing it through a bank or lender, using cash, whatever it might be. He'd probably use cash. He doesn't have any debt. He's very smart with his finances because he studies them intensely. But here we go. Here's his planned funding, $100,000 per year for 5 years. This is based on the present dividend rate. We looked at the guarantees and also an index strategy with the same product. But here you go. Breaking even when he's cash on cash between years 3 and 4. Year 4, he's paid in a total of $400,000 and he's got $404,000. Death benefits at $3.5 million, mainly because that gives him a MEC limit of, guess what? $100,000. And if you're new to this, that MEC limit of $100K, that's an IRS limit. Any of our policy design videos or modified endowment contract videos really go into full detail the importance of that and how we can set it. it has a direct relationship to an individual's age and death benefit. But here, plan funding after 5 years, doesn't pay a penny into it, cash value continues to grow, did exactly the same thing based on the guarantees, and it looks good. This is what he was attracted to. But at the same time, do we stop there and say, okay, sign right here, as Uncle G would say, his boss? No, we want to show additional options too with the same policy. So not additional options to sell them on, but to say, hey, Steve, this is what it looks like if you do everything according to plan. But if life happens and you only fund it at 50% of the total amount, so you have the ability to pay in $100,000, but you only get $50,000 per year in, what happens here? Well, what do we notice? The minimum commitment is exactly the same, $10,200 per year. The additional payment here, $39,800 instead of $89,800, for a total of $50,000. Okay, I get a total of $250 in. When am I cash on cash? In this example, when I max funded the policy, so if I 10x my minimum premium $10,000, total of $100,000. 10xing it is as aggressive as the insurance company will allow with the top companies. He's big into the 10x rule because that's where he works. So it was just kind of a nice coincidence in that respect. But as we look at this, if he max funds it, 10x's it each year, breaks even between years 3 and 4. If he does not do that, what happens? Still performs, but the break even's year 5, just about. He's paid in $250, he has $249, year 6 he's positive, continues to grow, but a little bit delayed break even point. Cash is definitely going to be less because I've only paid half in compared to the example on the left, but still a decent area to position money. Much more satisfied than his bank account that doesn't do anything. But then we also compare it to a worst case scenario. What it looks like if he only pays the minimum in each year. And with that, it's not attractive at all. In fact, in this example, we would say don't do it. Or if you did start a policy and life just happened, you say, I can't pay anything in. Like everything went south, I'm paying in $10,200 per year. Then what we would do is actually what's called a policy change. And we would take the base premium, kick it down to $1,000, kick the death benefit down to $350K instead of 3.5, which would give us a MEC limit of about $10K. Technical stuff. Point is, we would reduce the insurance expenses, kick everything down, and then of his $10,200 per year, he could still pay that in, but only a $1,000 premium expense, get more money to cash, and you'd see it breaking even right around year 5. And we've got some other content on that. I know it's a technical topic I just mentioned there. My point to mentioning it is in the event we are really underfunding a policy, I bite off more than I can chew, you can make adjustments after the fact. You just have to know what to do, ask the right questions. If you're an agent to the company, if you're a client or a policyholder to your agent, and sometimes the agent doesn't know, so they can do extra work. If you work with us, we've got a training program that goes through that. Anyway, this was a fun case to work and a privilege to work with Steve. Thoroughly enjoyed it. And I hope you enjoyed this. If you did enjoy the video, please hit the like button, subscribe, and as always, I hope this helps. Talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.